How to find and profit from hot stocks. Hi, I'm Tyler Ballhorn, founder of Stockscores.com and the author of The Mindless Investor. In this presentation, I'm going to take you through the basics of my approach to trading the market. Now, when I say trade, most people tend to think day trade, but trading really doesn't have anything to do with the time frame that you hold a stock. It's more about an attitude and approach to the market where our goal is not to be a short-term trader, but simply to think like a trader, which means we buy stocks when they are moving, when they are outperforming the market, and when they stop doing that, we get out of them and move on to the next opportunity. Now here's an example of what I mean. This is a 3-year weekly chart of a stock that I've traded this year, a company called Red Knee Solutions. What's important is that it outperformed the market over the last year, and you can see with these weekly bars on this chart that week after week that stock went into a market-beating upward trend. Now, going through 2009, 2011, 2012, the stock really wasn't doing anything, and no matter how much I might have liked the company's fundamentals, the fact that it wasn't beating the market means that I wasn't interested in making a trade. So that's what I mean when I say having the trader mentality. It's all about finding the stocks that are beating the market, and that can be a longer term trade like this one, which is essentially a trade that lasted a whole year, or it can be a much shorter term time frame. The chart that you're looking at on screen right now is a 30-minute chart going back 15 days. But the concepts and the themes to why this was a good trade are no different than why this was a good trade. And what I'm going to teach you in this presentation is to know how to find these kinds of stocks, these stocks with market-beating potential, whether it's a long-term trade that lasts many weeks or even years, or whether it's a shorter-term trade like this one, which might only last a few days. You can even apply this methodology to very short-term day trading. Here's a trade that met my criteria, and in this case, instead of holding the stock for days, the hold was actually only for a few hours. But again, the concepts and themes, no matter whether you are a day trader, a swing trader, or a longer-term position trader, are all the same. And that's what you're going to learn in this presentation. Now, I've been teaching people how to trade the stock market for over 13 years. And my approach to teaching has evolved over time. I now go through a number of steps when I teach someone how to trade. We start with foundation skills. These are skills for stock analysis and risk management. Once you understand those basic skills and have practiced them to the point where you can see these patterns in charts instantly and know how to manage risk effectively, then you're ready to move on to strategies. These are the rules for when to buy, when to sell, how to manage risk, and how to manage your emotions. You then have to practice executing those strategies, but I believe it is best to do that without taking risk. And so I built a risk-free trading simulator so that you can practice trading without using any real capital. Once you've gathered that experience and confidence, you're ready to apply those skills in the real market. And as your trainer, I support you through that process with email support or even more one-on-one type support. Now that's my typical trader training program. In this presentation, I'm going to condense that into a mini training program. We're going to teach some of the foundation skills together. You're going to learn those. We're then going to move on to the strategies. I'll show you a few different strategies. We'll look at a simple long-term strategy that takes 5 minutes a month to apply, a medium-term strategy that only takes 15 minutes a day, a swing trading strategy that you can do an hour a day, or a day trading strategy that you can do all day. I'm going to demonstrate the tools that I use. These are offered on my website, Stockscores.com and Tradescores.com. Now, these tools allow you to scan the market and practice trading with no financial risk. At the end of the presentation, I'll talk quickly about the training programs offered by Stockscores to teach you how to beat the market, either as an investor or a very short-term trader. Ultimately, we want to manage risk and focus on the stocks with the best potential. And I can teach you how to do that in my different training programs. All right, a little bit about my background. I was educated in finance at the University of Calgary. I graduated in 1994. And while I was going to university, I started trading with $3,000 of capital. I was only 19 years old, but at the time I was pumping gas, going to school, learning how to get a understanding of business and that sort of thing. When I came out of university, I wanted to be a trader, and that's really what I focused on. But the tools that I needed weren't out there in the market, and so I built them myself. The tools that you find on Stockscores.com, many of them just can't be found anywhere else because they are tools specific to my approach. I started Stockscores in 1999, and it has grown into a community of traders used by people all over the world. We have users from over 50 different countries. Now, in my own trading, using the approach I'm going to teach you today, in the last few months, I've had a 21% gain in my portfolio. But that's not why I trade. Yes, the money is great, but it's really about freedom. Trading can be done anywhere that you can plug into a wall and get an internet connection. And so it allows you to travel, to have the freedom to trade when you want, where you want. You don't have to quit your job. There's trading approaches that can work well with the style or the lifestyle that you have. I like to trade full time, but that's not for everyone. For someone who simply wants to manage their retirement portfolio better, I've got strategies for you as well. All right, so now let's get into the foundation skills. Let's learn the basics so that you can evaluate any stock in less than 10 seconds. Now, I'm going to tell you that while most people focus on buying the right stock, that's actually not the most important skill. Managing risk is more important than picking the right stock, and I'll demonstrate why as we go through this presentation. Now, we're going to start with how to read charts. There are 6 essential elements to reading stock charts. You can see them on screen. They are support resistance, optimism pessimism, price volatility, and abnormal activity. If you understand those 6 things, you can analyze any stock, any commodity, any currency, anything that trades and has a chart, you can read it. But the building blocks to doing that sort of analysis is something I call inflection points. Now, I've labeled the inflection points on this chart. They're the blue arrows on screen, and they occur at any price peak or price valley. Anywhere the stock stopped going down and started going up, you've got a price floor. We call that an inflection point low. Anywhere stock price stopped going up and started going down, you have an inflection point high. So really, when we're looking for inflection points, all we're looking for are peaks and valleys on the chart. And these inflection points are the building blocks of chart patterns. They allow you to do anything that is done with an indicator, whether you in the past have used stochastics or MACDs or price pivots. All of those concepts really come back to the 6 elements of chart patterns that I mentioned on the last slide. And to find those 6 elements of chart patterns, you first need to be able to identify the inflection points. So when you're looking at a chart, very simple, look for peaks and valleys and put a little dot or a little arrow on them, and in doing so, you will have defined the inflection points. Now, we can draw horizontal lines at the inflection point lows, and in doing so, we have established support. Now, these are more than just horizontal lines. I have a bit of a problem with a lot of technical analysis books because they all teach what support is, but they really don't talk about what is behind support. The market is a place where people argue about what companies are worth. The buyers buy because they think the stock is worth more. The sellers sell because they think the stock is worth less. When we see floors on the price chart, what we're really seeing is a line in the sand that has been drawn by the buyers and sellers where there is a belief that the fundamentals of the business, what the company does, what its true value is not worth less than that floor price. Now, these change over time because as new information comes into the market as new fundamentals are learned about the company's business, the market will adjust where those floor prices should be. But on this chart, you can see that there are a number of clearly defined floor prices where the market has said, we don't think this stock is worth anything less than that floor price. So where I have my cursor right now, that's just a little over $1. And for a number of months, and keep in mind, this is a weekly chart going back 3 years. So for a number of months, the market said, we don't think this stock is worth less than $1. Anytime it got to that dollar level, the buyers came in and said, hey, that's low enough. We buy the stock to sort of protect its value. And the sellers, they don't have a willingness to sell below the dollar. And so the market has established a minimum fundamental value for the stock. Now these also act as psychological barriers because you will tend to see markets bounce off of the same floors over and over again. The market remembers where previous lows were. And so support is important because it not only represents the market's definition of fundamental value, but also defines a psychological barrier which takes a lot of effort by the market to break through. The opposite of support is resistance. It is a ceiling price, an upper limit on what the market thinks the fundamentals are worth. I've drawn here in red lines these lines of resistance. They're the maximum price that the buyers were willing to pay for the stock over a certain time period. So where I have my cursor now, you can see that over the span of 5 or 6 months, the market came up to the same price ceiling and then got stuck. And the market then took the stock down. And then when it came back again, it got stuck again and it came down. And then over the span of a number of years, this stock was unable to break through that $1.50 price ceiling. Every time it got to $1.50, it stalled. The buyer momentum was lost. And that's because the market didn't believe that the company's fundamentals were worth more than $1.50 a share. But on this day, this week, because this is a weekly chart, you finally see that the market has a willingness to break through that line of resistance. And that is important because that breakthrough resistance tells us that investors have some new information, some new fundamentals that justify paying a higher price. And that's why that stock was then able to go into an upward trend. It is now being driven by fundamental change at the company that makes the stock worth more. And as more and more people learn about that information, the stock price goes up. So we've covered now support and resistance. We understand 2 of the 6 things that we must understand to be able to read price charts. Now the next 2 begin with optimism. Optimism is the mood of the market that is positive. We don't want to buy stocks unless there is optimism. To do so would be like trying to paddle a canoe up a river. It is much easier to go with the current of the market, and we can understand the market's current simply by looking at the chart and looking for areas where the bottoms are rising. So if you look where I've drawn these green lines, you can see that the bottoms are rising over time. That means that the buyers are in control of the stock and the market is optimistic. The market is receptive to positive fundamental change when there is optimism. How do we find optimism? All we have to do is look for rising bottoms. So label your inflection points, look at the inflection point lows, and if those are rising from left to right, you have a market that is optimistic. Of course, the opposite of optimism is pessimism. And we want to avoid stocks that have pessimism, not because the fundamentals may be bad, but because the market doesn't like the fundamentals. The perception is negative. And perception in the stock market is everything. You cannot fight the mood of the market, and therefore you don't want to buy stocks when there is pessimism. Now, how do you know when there's pessimism? Very simple. Look at the chart. If there are falling tops on the chart, you have pessimism. So you can see where I've drawn the red line on this chart, the tops are falling over time, and therefore the market is pessimistic. And that is a stock that you want to avoid at that time because the market won't give Good fundamental change, much respect. They're not listening. The perception is negative, and therefore that stock is going to have a hard time going up. It is not until pessimism turns to optimism that we should take an interest in a chart. And that is no different whether you're looking at a 3-year weekly chart like we're looking at now, or whether you're looking at a 2-minute intraday chart. Don't fight the mood of the market. All right, we're going to move on to our 5th of 6 categories. This one is price volatility. How much is price changing over time? On the right-hand side of this chart, in the period where the stock goes from $1.50 to $6, there is a lot of price volatility. Week after week, price is changing. There's not a lot of agreement among buyers and sellers over time about what this stock is worth. But look for periods when the stock is in a narrow sideways trading range, like where my cursor is now, or going back over here where again the stock was in a narrow trading range. Anytime I see a stock going sideways in a narrow range, I know that the buyers and sellers have come to some agreement about what the fundamentals are worth. They've looked at all of the information out there in the market about that company, and they've said, okay, we believe that this stock is worth no more than, in this example, $1.50 a share, but also no less than $1.25 a share. There is strong consensus among the buyers and sellers about what the stock is worth. On the left-hand side of this pattern, you can see that you don't have that same consensus. Price was drifting lower, then it was moving higher, and so there is much more price volatility. We want to find situations where price volatility is minimized, where the market has come to an agreement about what the stock is worth. And the easiest way to see that is look for lines of convergence. If the line I draw across my bottoms is converging toward the line that I draw across the tops, then I know consensus is building. The volatility is compressing. And at the right-hand side of this triangle pattern, where I've got my cursor right now, there is strong consensus among the buyers and sellers. Day after day, week after week, the buyers and sellers said, we don't think the stock is worth more than $1.50, but it's also not worth more than $1.25. And that is what makes this breakout through resistance so important. You will hear chart analysts talk about breakouts all the time. Most breakouts do not lead to market-beating profits. You have to qualify the breakout. And the best breakouts are those that come from low price volatility, because you move from a situation where everyone agrees about what the fundamentals are worth, and then a day later, a week later, whatever the time frame that you're looking at, but all of a sudden there is a source of new information that justifies people paying, in this case, a higher price. So breakouts from low price volatility are much more important than breakouts from high price volatility. All right, our final element, and it is the most important element. Every one of my trading strategies is built around the concept of abnormal activity. Abnormal activity in terms of price, abnormal activity in terms of volume. Where you see the blue arrows on this screen, you've got abnormal price movement and abnormal trading volume. It doesn't take a rocket scientist to look at that chart and say, yeah, the price gain for that bar, that candle, is much greater than any other week prior. And the volume traded is much higher than normal. You've got a situation where something got investors excited about this stock. There must be a significant change in the perception of the company's fundamentals to justify people paying a much higher price. This stock went from a week where no one was willing to pay more than $1.50 to all of a sudden being able to pay close to $2. And the volume of stock traded was all of a sudden much higher. That tells us that there is significant fundamental change underway, and that is the thing that will send this stock higher. So when you are looking at chart patterns, when you are looking at stock charts, a good buying pattern needs some very simple things. A break through resistance, from low price volatility or sideways trading, from optimism, which is rising bottoms on the chart, with abnormal activity. Now we must have abnormal price action. Abnormal volume is a nice to have. So let's go back to a chart. This is a stock that I bought recently. And you can see that this stock went from pessimism on the left-hand side to optimism, where the bottom started to rise. So we've switched from the sellers being in control to now the buyers being in control. We can say that because the bottoms are rising. The market also established clear resistance just over $1.80 a share. For a number of weeks, this stock could not break through $1.80 a share. But then in 1 week, out of low volatility from optimism, the stock broke through resistance with abnormal price action, and volume was higher than normal. That tells me that the market was excited about something, about this company's fundamentals getting dramatically better. And that is the best sign that this stock is ready to go into an upward trend. So why does it work? Information moves stocks. However, the spread of information is unfair. Most investors are trading with publicly available information. Those that follow the company the closest are more likely to have private information, whether it is through their position with the company, their relationship with the company, the fact that they might be an expert in that company's industry, or perhaps they are a large investor with the resources to do really good fundamental analysis to dig up information that most people don't have. Those people have an advantage because they know what the market will be trading on in the future, what the information that is going to come to the market in the future will be. The spread of information is unfair. It does not go from the company specific to the great public world out there instantaneously. It moves through a few stages. Of course, there's the insiders that know things the first. Then there are the really well-educated, well-knowledged people that are close to the company. Then there's the savvy traders who follow market action. Then there's the pretty good traders, a larger group that maybe get in a little late but still early enough to make a profit. And then there's the general public who are trading on public information because they just don't have anything else to work with. Well, the public is buying in at the top, and the people that are closest to the company are buying in at the start of the trend. If you want to beat the market, you have to avoid being part of that big public group trading on public information, and instead, you have to be part of that privileged group trading on private information. Now, the problem is, most of us don't get private information, so we have to do the next best thing, which is follow the message of the market. Look for abnormal activity from predictive chart patterns because it tells us that someone, a small group of investors with great information, it tells us that they are trading on something new, something important, something big fundamentally. And when the rest of the market learns about that, that stock is going to now be moving well into a trend. If we can follow those smart people, those well-informed people, by following what they're doing in the market, we can beat the market as well. All right, now let's talk a little bit about risk management. The risk of a trade is the difference between your entry price and your stop loss price. You're always going to plan to lose on a trade by planning to exit the trade if it closes below support before your entry signal. And this will make a little more sense when we look at a graph in a moment. The other factor that you need to understand is risk tolerance. Now, this is a personal matter. How much are you willing to lose on a single trade? Now, that's a function of your age, how much capital you have, your trading experience. There's a lot of things that contribute to understanding what your tolerance for risk is. For some people, it might be $100 a trade. For others, it might be $10,000 a trade. What's important is that you never take more risk than you are willing to lose, because if you do, you're going to become an emotional wreck and you will make trading mistakes that are destructive. Now, ultimately, the position size of our trades is based on our risk tolerance and the risk per share of the trade. Let's look at an example here. We're back to Red Knee Solutions, the stock I've been using in this presentation. Now let's suppose that we're buying the stock at the blue arrow on the break from low volatility through resistance from optimism with abnormal activity. We've gone through that enough. We're buying the stock at, let's round off and say $2, and we're going to plan to lose at $1.25. Now I chose $1.25 because that is the floor price before the breakout. If that breakout was caused by new information, and that new information turns out to be false, which happens sometimes, then we would expect the stock to fall down below that floor again, to fall back into the pattern that it was in before the new information hit the market. And so that's why we put our floor price at the red line on this chart. All right, so we're buying at $2. Our stop loss is at $1.25. Our risk per share is 75 cents. If we buy 1,000 shares, our risk is $750. If we buy 2,000 shares, our risk is $1,500. If we buy 300 shares, our risk is about $250. My point is that you adjust your position size to reflect your tolerance for risk. You say to yourself, okay, my tolerance for risk is $750. The risk per share on this trade is 75 cents, and therefore I will buy 1,000 shares. Now, taking this approach to every stock that you trade allows you to make every stock you trade have the same amount of risk. All we do is adjust position size for the riskiness of the stock. The more volatile the stock is, the smaller our position size in dollar terms will be. Now, once the stock moves into a trend, we judge our success on the trade based on reward for risk. Reward for risk is how much we are making for the risk we took. At the first line where my cursor is here, that is a reward for risk of 1. If we sold that stock at roughly $2.75 or so, we would be making 75 cents a share in profit, or $750 if we had a 1,000 share position. Now every subsequent line is a multiple of that reward for risk. This stock maxes out at 1, 2, 3, 4, 5, 6, 7 times risk. That means if we did that $750 risk trade, we bought 1,000 shares, this trade would be up 7 times $750, which is, what is that, 7 times 750, or pardon me, $750 is $5,250, quickly calculating in my head. What that really means, though, is that this winner pays for 7 losers. Because if we always take our loss at a risk reward of -1, that means our average loss is going to be somewhere around -1, allowing for some slippage. And if we have a winner that earns a risk reward of 7, then we've got a trade that has made us 7 times our risk tolerance. That means it pays for 7 losers. And you don't have to be right very often if you have trades that pay for 7 losers. All right, let's go into some strategies now. I'm going to show you a long-term investment strategy that is very simple. If all you did over the last 13 years was buy the S&P 500 ETF, symbol SPY, anytime the monthly chart closed above the 12-month moving average, and then sell the position and go short the market when the monthly chart closes below the 12-month moving average, you'd have enjoyed considerable gains. Here's the chart which we'll look at before we look at the performance of this basic strategy. So the first red arrow on the left is our first signal to short the market. That was late in 2000. And that short worked out well. We held the short until early 2003 at the green arrow, where we then covered the short and went long. Now the reason we did that trade is because we had this monthly candle close above the 12-month moving average. And we held that trade all the way until late in 2007, when we sold that position and went short. Why? Because the monthly candle closed below the 12-month moving average. Now in the course of 13 years, this strategy, very simple strategy, made 2, 4, 6, 8, 10 trades. It made 10 trades in 13 years, and the success of that dramatically outperformed the buy and hold strategy. Buy and hold earned about 26%, whereas this particular in and out, buying and shorting the market, anytime there was a moving average crossover, earned 473%. My point is that you don't have to trade really actively to beat the market. Now you can. If you want to be a day trader and make 10 trades a day, great. You can make a living off of that. But if all you want to do is just do better in your long-term investment portfolio, simple strategies can help you beat the market. And that's what I love to do, is develop strategies. Now let's look at one of my medium-term trading strategies. Very simple. This is using some tools on Stockscores, which I'll show you in just a moment. It's called the Stockscores Simple Strategy. I look for stocks that have a sentiment stock score of greater than 60, a signal stock score of greater than 80, and a good chart pattern. Now we already know what a good chart pattern is. That's a breakthrough resistance from low price volatility, from optimism, with abnormal activity. Now we can search the market using a tool that I developed called the Market Scan to find those exact things. So here I am in the Stockscores Market Scan tool. We've got all these filters available to us. I can set the tool to look for a signal score greater than 80, a sentiment score greater than 60. We want an abnormal day up, because that was one of the criteria of a good chart pattern. We want a breakthrough resistance, so let's say we want to break through 80-day resistance. And let's, for simplicity, also say that we don't want to look at stocks that aren't very liquid, so only stocks that have traded 1,000 times a day. Now you can see that there's lots of filters on this tool. I've only used a few of them, but we're going to now scan the market, and it just went through every stock that trades in North America and found 23 that meet the basic criteria of what I was scanning for. Now, these 23 have got good stock scores. I'll explain the stock scores in a moment. But they don't necessarily have good chart patterns. They fit the basic criteria. It allowed us to go from, a huge list of stocks, 10,000, down to 23 that meet our basic criteria. But I still need to look at these charts to see if they have the chart pattern that I want to see. So it's now at this point that we start going through the stocks one at a time, looking for these predictive chart patterns. So our first stock is breaking through resistance. We can see that from low volatility. It's been trading sideways for a number of months. Volume was higher than normal. Obviously got abnormal price action, so it meets some of our basic criteria. Now I have some other criteria which I'm not going to outline in this presentation, but one of the issues with this trade is it's going to run into some resistance up here at around $1.15, $1.20. And because of that, I'm not going to take this trade. It just doesn't have enough reward potential for the risk of the trade. So I move on to the next one. And that's really the process. Looking at the chart, looking for the pattern. I can see in this pattern it's a good stock to hold, but it doesn't fit my buy criteria, so I move on to the next one. The research process is simply going through charts one at a time based on what the Market Scan tool turned up. And when I see something I like let's say I like this one, it's okay, it's not outstanding because it's been trending higher for a while, I'll often look for time frame confirmation, going to a longer term chart to see what is that long-term picture. Long-term picture on this one is a stock that's been going up for long enough, and I think that buying here is too risky. If I owned it, I'd love it, I'd hold it, but it's not a trade I want to enter now. But that's the research process. The tool, the Market Scan tool on Stockscores, allows me to go through thousands of stocks, whittle it down to a short list, and then apply my rules of what to look for in those charts to really get to the stocks that have the best potential to beat the market. So here's an example of a stock that I found using that exact same process. I found this one a few months ago. I don't know anything about this company, but I know that at the blue arrow, the market was excited about something. You can see that it has rising bottoms on the chart. It has compressing volatility. It's been trading sideways, but the line that I've drawn across the bottoms is converging toward the line I have drawn across the tops. It is breaking through that resistance with some abnormal activity. My sentiment line is above 60. My signal line, the blue one, is above 80. Now you're probably saying, well, what do those lines mean? Here's what I did. It's hard for a computer to see that price pattern. It is easy for a computer to see elements of the price pattern. So I developed a scoring model that says, let's look at the components of good chart patterns and give them points. Every stock starts with 50 points, and I add points for good things like rising bottoms, breaks through resistance, breaks with abnormal activity, those sorts of things. And I take away points for negative things like falling tops, breaks through support, breakdowns from low price volatility. And so you can see when this stock was pessimistic, we had very low scores. As optimism started to build, our scores got higher. And what you'll find is that when there's optimism, the green line, which is our sentiment stock score, will be above 60, and our blue line, which is our signal stock score, will spike up above 80 on that breakout from a good pattern. Now, we don't buy every situation where there is a spike above 80 and a sentiment line above 60. We only buy those where there is a good chart pattern as well. Now, this scoring tool will put good stocks in front of you. It allows us to get the computer to take the market from 10,000 stocks down to a manageable list so that we can apply the intelligence of our human brain to look at that chart and say, yes, that is a good chart pattern. The stock scores help me find it, and I can see it by looking at the chart. Now, what's interesting about this chart is that this stock made this breakout early in September. I bought the stock, low volatility, breakout, all of the things I look for. I had no idea what the company does. I mean, I can assume they're a steel company. I don't care. What I know is that the people that follow that company the closest found a reason to buy. What's interesting is right over here where this price gap is the day that a large investment bank, Goldman Sachs, arguably one of the smartest banks on Wall Street, put out a buy recommendation. So their public release of their buy recommendation was here, but the market started to know something good was coming over here, showing you yet again that the market is not fair. The people that know the most act before the information is public. All right, let's take a look at a swing trading strategy. Now, swing trading is holding a stock for typically a few days, perhaps a couple of weeks. I can take the same concept and apply it to a short-term chart to look for a good trading opportunity. So here is what should now be a very familiar pattern. We've got a breakout at the blue arrow from low volatility, from optimism through resistance. And look at what that stock did. Following that break from a good chart pattern, the stock went from about $3.75 a share to $10.50 a share in just 2.5 days. I didn't know anything about this stock, but the market told me that something was happening. Now, the challenge is not to see that pattern. That's easy. The challenge is to find these things in a time-effective way. If you find it too late, you've missed the boat. You got to find it when that break is happening. You got to be on that stock when the people that know the most are on that stock. And I have created tools to do exactly that. The first, you've already seen, that's the market scan tool. It is running delayed. It is okay for swing trading and position trading, but it's too slow for really active day trading. And so what I've done is I've taken the concepts of what I do in Stockscores in the market scan tool, and I've made them work in a piece of trading software called TradeStation. TradeStation allows me to do the same analysis, but in real time. I have created my own proprietary indicators that you can plug into TradeStation so that you can find the stocks that are doing this kind of stuff as it happens. It allows me and my students to catch these trades at the blue arrow instead of later on as the rest of the public starts to figure it out. We can be in at the ground floor because I've built some tools to find those stocks the soonest. It's not a difficult process. It takes maybe 10 minutes to go through the entire market at the start of each trading day in that first hour and focus in on the stocks that are moving abnormally from good chart patterns. And that's one of the ways that I swing trade the market. Now we can take it one step further, shorten our time frame even farther, and look for day trading opportunities. But again, it's the same picture. Rising bottoms, flat line of resistance, low volatility, breakout. What is important is not to look for the right pattern, but to look for the right pattern on the right stock. You have to apply this pattern to stocks that are trading abnormally. And I can do that using Stockscores, going back into the market scan tool, and scanning the market using my day trader scan, which is one that is available to my students. I'm going to select here day trader. It's going to now search the entire market for the stocks that meet the criteria of this strategy, and it found for me 56. Now the market's closed right now, so this isn't of much use to us, but I do this scan early in the day to build my watch list of stocks to watch. And then I watch those charts, and in this case I'd have to watch 20 or 30 stocks a day for the right pattern setup. What I teach my students is what to look for, how to find it before everyone else. We apply our risk management based on where the entry price is, where our support price is, so that we don't take big losses. We never take big losses. We let our profits run. Our average winner is bigger than our average loser. That's how you make money as a trader. If you want to be a successful trader, keep it simple. I believe that all market-beating trends, and you can verify this by looking at it for yourself, all market trends start with abnormal activity. So scan for abnormal activity. Whether you use the Stockscores market scan to do that or my proprietary indicators for TradeStation, you can now focus in on the stocks that are trading with statistically significant abnormal behavior. You look for breaks from these good predictive patterns from sideways tradings, focusing on the stocks that have surprised the market. You want to limit your losses when you're wrong with good risk management and let your profits run with a good exit strategy. I teach all of those things in my trader training program. It starts with a read of my sort of basic book, The Mindless Investor, which gives a broad overview of my approach to the market, why it works, the concepts behind it, some of the basic things for reading charts and that sort of thing. It then takes it to a second level, which is the Stockscores Foundation course material. That's where we get into the finer detail of what I've talked about today. Today I've given you the broad overview. In the Foundation course, we go through the details. That allows you to be ready to start applying the strategies, either the active trader strategies or the investor strategies. If you want to look at the market every day for either an hour in the morning or all day if you want to be a day trader, you're going to focus in on the active trader strategies. If you want to manage your retirement portfolio better, you only have the time or the desire to look at the market on the weekends or in the evenings, then you're going to focus in on the investor strategies. Concepts are the same, we just apply them to different charts in different ways. If you want information on one of my trader training programs, either the live classes that I do from time to time, I don't teach live classes very often, but from time to time I do them, or the home study options, which allows you to go through all my material through videos, through correspondence with me, go to stockscores.com/learn, stockscores.com/learn, and you can get a schedule of any classes I might be teaching or details on the active trader courses. The investor course teaches position trading strategies, 15 minutes a day or 15 minutes a week to find the opportunities, 5 minutes a day or 5 minutes a week to monitor your holdings. The emphasis is on risk management. We don't take big losses, we manage our risk effectively, and we've got strategies that have a positive value. The active trader course, based on the same foundation of knowledge, but applying day and swing trading strategies that take anywhere from 15 minutes a night to an hour a day or all day. That's up to you. But as always, the emphasis is on risk management and trading strategies that have a positive expected value. Both courses start with the Foundation Live class. Now my next class that I'm going to be teaching at the time I'm doing this video is December 7th, but you may be watching this video a year from now, so check the website, stockscores.com/learn, to find out when my next class is. 12 weekly lessons and assignments. Final assignment, I'm going to help you create a trading plan to either manage your portfolio or to focus in on the day trading and swing trading strategies. Throughout that process, you get email support from me. I don't teach a lot of people every year. I teach a small number so I can give a personalized level of service. And when you send me a question, you're going to get an answer back very quickly. You know, I'm watching the market all day, trading the market all day. I sit in front of my computer all day. And so a lot of that time is boring. I sit there and I answer email from my students to help them learn the material. It's not complicated, relatively simple, just take some practice. You're going to use the Stockscores market scan and other tools with the investor course. You're then going to practice on the simulator that I created at tradescores.com. I invested hundreds of thousands of dollars on this tool to give you a place where you can do simulated trading, and it's all free. It's all part of what we offer at TradeScores for free. You can trade the Canadian or US markets with my approach. The active trader, again, email support from me using the market scan tool on Stockscores, or you may want to use TradeStation. What I include with the active trader class is my proprietary TradeStation indicators, which cost me thousands of dollars to have created. It allows you to catch the movers before everyone else. And that is one of the things that gives me and my students an edge in the market. We know what to look for, and there's lots of people that know what to look for, but we can find it sooner because I have built these proprietary TradeStation indicators that allow me to do so. Now, some of you may want to take your learning to a much higher, more personalized level. I mentor 10 students every 6 months on how I do my trading. It's one-on-one via Skype. Being on Skype allows me to show you what's on my screen. I can see what's on your screen. We can really have a much more personalized, in-depth educational experience. It includes all of the strategies from the investor and active trader curriculum, but it's one-on-one. And so if you feel like you want me to train you personally, consider the mentorship program. You do have to apply. I don't want to teach people that have unrealistic expectations of their trading. I want people who are going to work hard. And if you sort of satisfy those criteria, then you're a good candidate for my mentorship. When you're a mentorship student, we're working together on what you need to trade profitably. You do all the assignments, but you also receive one-on-one help from me on whatever you need. It's very flexible, but it's the maximum leverage of my 20 years of trading experience. So the process is simple. When you sign up for one of my training programs, you review the home study material. You either come to the foundation class live or you review the videos of a live class as a home study. You then work through 12 assignments and strategy lessons. You have the choice of doing those one per week, or I can send them to you all at once if you're really a go-getter and want to work through the material at a faster pace. You're then going to practice executing the strategies with the TradeScores simulator, and with confidence and practice, you are ready to execute those strategies in the real market. One more time, for information on my upcoming classes, either live or as a home study option, go to stockscores.com/learn, and there's some videos on that page as well, lots of information about my classes. We never do high pressure sales at Stockscores. I want people who want to learn how to trade, and I'm willing to give them what I've learned over the last 20 years. But if it's not right for you, I won't bug you, plain and simple. If you want to contact me directly, there's my email address, tylerb@stockscores.com. My Twitter handle is @Stockscores. I also have a YouTube channel where each week I upload a new video, analysis of the market, a trading lesson. I encourage you to watch those at youtube.com/stockscores.com, where .com is spelled out, and you can see those videos. All this stuff is free, of course. Well, that's been my presentation. I hope you've enjoyed it. Just remember, the person at the top of the mountain did not fall there. If you want to beat the market, it takes hard work, and I can shorten your learning curve. I can give you the benefit of 20 years of trading experience and help you get to the top of the trading mountain that much quicker. Hope you've enjoyed the presentation, and trade well.